In this wealth series video, I'm going to talk about risk versus reward. A lot of times people think about trying to earn as much as they can, and so they might take on riskier bids than normal. So say for example, day traders or forex traders or Bitcoin traders, these are all high risk, yes, high return, but don't forget high risk assets. So you could be in when the market is hot, or probably by the time you've heard about it on the news, it's probably already too late. So a high return investment like that, yes, they come and go. Some people get on the bandwagon at the right time and then they lose big. It's more like gambling at the end of the day when you're getting high value bets and you're putting all this money on something that may go up or it may go down. I think it's okay to have some level of risky investing, but not at the expense of building a solid core, safe foundation. Now, one would argue that you want 80% of your wealth in core growth assets, a smaller percentage, maybe 5 or 10, in high growth assets, and then a smaller percentage, yet again, maybe 2 or 3, in ultra high growth or high risk or wild card assets. So I made a trade once on a biomedical stock. It was a very low dollar per share, so I was able to buy a lot of shares. It went up about 400%. I sold immediately, and a week later, it completely dropped. Now, I didn't time the market very well. That was mostly by chance. I probably could have gone another week, but I risked losing everything. And the point of that exercise was that it was a low risk, high return activity. I invested $5,000, which was less than 1% of my overall portfolio. I then turned that into $25,000. So it grew 4 times more than the base amount. So that growth meant that I made quite a significant amount of money in a relatively short time. But I was incredibly lucky, and I've very rarely done that across any of my investments. There's plenty of investments where I've lost money, but again, no risk, no return. That risk was relatively low in the grand scheme of things, and the return was considerably high. Now, all of my other investments, I expect to get about 8 to 10% per year recurring returns. So it means that it's a much safer asset. It's something that grows consistently, and it generally doesn't go backwards. In fact, if it does, this type of asset generally is a good thing to get back into, because when the prices are down, it means it's cheap and you can buy more. But other assets are not always that way. Other market factors can play a part in reducing the value of the assets that you have. So if you're going to make investments, you need to make investments that are relatively safe, because you can always make more money, but when you lose it, and when you lose a lot, it is really, really hard to get it back. So losing 50% of the value of something means that that value of that then has to double to get back to where it was. So it's much easier to lose money than it is to make money. So just avoid losing money. Another thing I want to talk about is debt. A lot of times people build up debt because it seems easy. And, when things are going good, debt can be really useful, and it gives you leverage, it allows you to buy bigger assets, allows you to get in on an asset that you may not otherwise be able to get in on. However, debt is leverage both ways. It leverages you up and it also leverages you down. So when you can't afford the repayments, the pain and frustration and risk is significantly higher. So you then have to, keep those obligations. You have to make those repayments. That could mean that you're eating beans on toast for a little while longer. If you own the asset and things go backwards and you're not making the revenue that you were, you just have slightly less revenue. But if you have debt, you have a repayment to maintain. You have potentially, you're making losses every single week, every single month. And debt can be very hard to get out of. So it's advisable to avoid debt where possible, unless, of course, you have a reasonably good expectation of making a higher return than what you are spending. For example, I might pay for a mortgage or a loan at 5% if I think I can make 10% on the money. Or a loan at 10% if I think I can make 20% on the money. But you have to be very sure that you are able to do that and that the risk of not achieving that goal is quite low. Because if you borrow money at 10% and then you can't make it back at all, well, now you're negatively leveraged and it's going to cost you dearly. Yeah, there's tax savings, great. Yes, there's deductible interests and all of that sort of stuff. But going broke is going broke, and that does not feel nice, and it reduces your living standards. It puts a lot of stress and a lot of strain on you. So one way to reduce that stress and strain is to pay down debt as fast as possible. One of the ways that you can do that is making early repayments. It's a very simple thing. Just add another $10, $20, $50, whatever you can afford to that repayment schedule so that you get through those repayments faster. That is not going to reduce the repayment amount, but if you get used to paying a little bit extra into that repayment and you have a little bit of discipline, there's a good chance that you're going to get ahead and you're going to pay less interest overall. And yes, again, you can tax deduct interest, but that's not always a good thing. Profitability is profitability. If you're losing money, you are losing money. It doesn't matter how you skin it. And I know that there's a lot of people out there that say, yes, you should leverage up as much as you can and buy more assets, particularly if they're like capital growth and things like that. That's a whole lot of risk. It's a whole lot of short-term pain for kind of some long-term gain. I think you really need a good mix in your strategy. You need some short-term assets, you need some medium-term assets, and you need some long-term assets. I personally like things that I can liquidate quickly because in the world of business, things change fast. If you're an employee, you have a relatively fixed income, but your upside potential is minimal. You pretty much can make the same salary next year, maybe a 3% increase. Change jobs, you might make a 5% increase, maybe a 10% increase, but you're relatively limited. You run a business, you have significant risk of having no income for a very long period of time, but you also have a fairly significant risk of being able to double, triple, quadruple your income in a short period of time if you have a really good year. Again, you have to be disciplined. So you need assets that can handle that wild and crazy ride. You don't have the repayment ability that you think you have or that you have in other jobs or in other industries or other cores. You might go a year where sales are really bad and you have to chip some of your own money back into it. If you have an asset that you can liquidate quickly, then that's very useful. It might save you the business. Obviously, you want to make a decision and you might decide that, well, it's not worth saving. We've put a lot of money and time and energy in. Well, we're not going to continue to go into negative balance and sacrifice the major amount for the lesser. We're not going to go into a negative balance and sacrifice all our assets to save another one. You need to make some judgment calls at times. So I think if you're going to go down the route of getting some interest, getting some debt, then you need to be very measured with that. You've got loan to value ratios. And yes, sometimes when you're early in your career, you're young, you work hard, you can get an extra percentage point. You can get lender's mortgage insurance. You can, expand yourself and stretch yourself because, well, that's the time to risk it, because when you're older, you need that and you don't have that same energy and you can't always work harder and longer and you can't always just, keep those repayments going. At a certain point, the bank will no longer lend you money. So you need to have a plan. You need to work down your debt. You need to work towards owning everything. And I know there are people out there that will say, no, you need to leverage up as much as possible. But realistically, it's your sleep at night factor. And if we're thinking about long-term wealth, yes, we might use debt to leverage into something. You also might use a little bit of debt or credit card, for example, to shield your own capital. So for example, getting a loan in a company, provided you don't have a personal guarantee, or if you're structured correctly and you do have a personal guarantee, a company can borrow money, and if it can't pay it back, well, that's down to the company. So you need to think about your structure and the way that you borrow money, and think about paying that debt down as fast as you can. And then once you've owned the asset full and clear, then you have the ability to make decisions, be flexible. You have equity. If you need to get that loan again later, you could probably use the equity that you have in your business or your property and do something else with it. But your equity, or your free and clear equity, is the thing that the banks measure. If you have a loan, you can't borrow as much as if you don't have a loan. So getting a loan in place or getting a loan off your plate is probably one of the best things that you can do. Always try to pay the biggest debt off first. Sometimes that biggest debt is not necessarily in the interest rate. It could be in the terms. I once worked with someone who had a interest rate that was similar to another interest rate that they had, but the way the loan was calculated was actually quite punishing when you really analyzed it. So the first loan would pay the loan down with every repayment. There was a weekly repayment. It would go out on, for example, a Monday. And then there was an interest deduction immediately the following day. So it meant that the repayments were only ahead and up to date for one day. And so if the payment was $150, then the interest was charged at $140 the following day. That meant that every single week you never really got ahead except for the minimum repayment or the gap between the interest and the principal being the $10. So they were really only paying off $10 per week, and that was extremely punishing from a calculation method. The other loan that they had was a month-to-month loan, and it was similar interest rate, and the interest was calculated daily and charged monthly. That meant that if making 4 repayments in a month, or weekly repayments, for example, that every week that balance was able to be at that lower value and continually go down in value, so that when the interest was charged at the end of the month, that's when that loan balance would come back up again. So for those 14 days, 21 days, that was just a little bit lower, and then a little bit lower, and then a little bit lower, and that's what the interest was calculated on. Whereas the other version, as soon as the repayment was made, the interest was charged. And so the balance of the loan never got low enough to make it worthwhile in the interest savings. It was incredibly poorly structured. So the most important thing was to pay that loan out as fast as possible. In fact, that person got another loan to pay out that loan and actually save money in the deal because of the change in the way the deal was structured. So that being said, growing your wealth is a small, incremental thing that happens over a long period of time. Don't think about getting rich quickly. It's probably not going to happen. If it does, great, congratulations, winning the lotto. You're an outlier. But for everybody else, for most people, it's an incremental step forward and reducing your steps back. So your steps back are things like debt. Your steps forward are things like growth. So say, for example, if I have debt that's costing me 5%, I might look to do an investment that is going to make me 10%. However, for most people, they don't think like that, or they perhaps can't access deals like that. And so the best thing that they can find is an online saver account at 3% or 4%. Or then they look to doing property deals, which cost a lot. There's a bit of risk. There's a negotiation problem as well. So you might buy the house at, $500,000 and then immediately sell the house for $450 because of something that happened in the negotiation. Maybe you didn't make your money on the buy side. Maybe the other person was more aggressive on the sell side. So it makes it really hard for the average person to make investments like that. Unless, of course, they're going into something like the stock market. Now, that's a whole can of worms. You really want to get some advice. But generally speaking, an ETF or an exchange traded fund that trades the market, it's been well proven. The ASX 200 or the S&P 500 is a relatively safe bet. There are funds that trade in that. The risk is spread out over 200 different shares. They're the market leaders. And on average, it's been proven to grow between 8 and 10% per year on a compounding annual basis. So if you put in money and you continue to put in money, you don't have a loan on that because you can buy very small chunks of those shares. You might spend $50 to buy a share, $100 to buy a share. Whereas if you buy a property, you're spending, well, not only do you have to come up with a deposit, you're spending $400, $500, $600, $1 million to buy this property. And it comes with a loan and the fees and the taxes and charges and stamp duty and all these other things that go along with it. You have to negotiate. It takes time. It takes, generally 45 days or somewhere around there to settle. And in that process, the buyer can demand stuff, the seller can demand stuff, finance can fall through, it can go around again. So Personally, I like the simplicity of being able to go on when I feel like it, click a button, make a trade, and then when I want to sell it, click a button, it's gone. And I don't have to argue with anyone. I don't have to contemplate anyone. I look at a chart, I make a decision, I hit go, and that's it. But in order to do that well, you need to have discipline. You need to read the markets. You need to think long term. When you read the markets, don't get caught up. Stop reading the news. Don't buy the financial review. If you do, take a look at the long term articles. Do it once a month and do not look at it again, because every article is geared towards getting an emotive reaction. Should you buy this? Or this is crashing. This is going to blow up. And this other company is about to go bankrupt. Realistically, they're just trying to make newspaper sales. And that is the worst form of marketing you can look at. What you really should be looking at is industry papers, understanding the market, understanding the companies that you're buying, where they're going, what they're doing, trends in technology, trends in manufacturing. And that will help you make decisions about what you should buy. Personally, I would not suggest buying a company you wouldn't be comfortable holding for the next 5 or 10 years. If you don't believe in where they're going and what they're doing, don't buy them. If you think they're a risk, or if they're new to the market, or if they're unproven, don't buy it. Unless, of course, you've got 80% of your shares in something that's safe, well respected, well regarded, has good long-term prospects, and then you happen to throw $500 as a wild card and less than 1% of your total portfolio, you're just going to place a bet, literally a bet. Put some money down on this one thing that you think is going to be red hot. Give it 12 months, see what happens. If it goes, fantastic. If it doesn't, you've lost $500. Good on you. Nothing about building wealth should be short term. You should take a very long-term view on everything. Nobody's going to push you into a sale that you don't want to be in. There's no bargain that you can jump on. There's no scarcity that you can be swayed with. You make a decision when you're ready to make a decision. If someone is trying to push you, oh, this is the best thing, you have to get in before that time, it's probably a scam, or it's probably not a really good deal, and they're just trying to railroad you and get you to make that decision. I like to look for a number of evidence points from a number of sources before I make a decision. And those sources have to be credible. So if I decide to buy a particular share, I've heard about it before, I've understood it, I've decided that that's worth my while. If I'm going to buy a piece of property, I haven't just heard it from one particular source. I've read contrary advice. I'd look for evidence to refute that claim as well as support it. If you only look for evidence that supports your theory, then you are a victim of confirmation bias. That is where you look for things to prove that you are right instead of looking for things to prove you are wrong. It's very important that you don't get caught up in the emotion that this is money. It's just a number on a screen. If you look at it as a resource that you can use, something that you will try and test with, obviously property makes it a little bit scarier, but don't go buying in random areas that are regional from one mining town, because that mining company could shut down and then everything could become worthless overnight. That's a huge risk. Yes, there might be a good return. You might have a highly leveraged property, you might have good rents, but then something can happen and there goes everything. And then your property becomes absolutely worthless. The banks start recalling the loans. It's a huge risk. So think about the long game. Think about being safe. It's really hard to make it. It is very hard to lose it. Once you lose it, it is very hard to make it again. So make sure you come at wealth with that lens. So when thinking about wealth as a whole, small continual steps towards the goal, compounding interest wins the game almost every time, hands down. It's the classic tale of the tortoise and the hare. The hare gets tired, wears out, falls asleep. The tortoise just plods along, and before you know it, has passed the hare. And then the tortoise is wealthy. The rabbit didn't make it to the end. That's exactly what happens. There's a line from a movie where the star that burns twice as bright burns half as long. So remember that. The flashy thing, the latest trend, the latest cool investment, high risk, high reward, probably not going to get you anywhere. You could lose a lot of money fast. So be safe, be steady, be steadfast, be long-term thinking, and you will more than likely get there. Now, remembering what we were talking about with interest, your job is to get an on average better interest return and spend less, earn more. So less debt, more interest in your income. Now, quite often these online saver accounts are a little bit of a misnomer because generally you only get 0.5% or 1%, which is realistically less than what the value of cash decline is. So inflation is where the value of your paper money declines, and realistically cash money is a temporary and diminishing store of value. So it's only used in between times between assets. So if I sell a house, hold cash temporarily, and then buy a house, I'm going to lose money during that time or lose value over that time. So don't think about cash as an asset. It's really not. Cash is trash. And it's only a temporary store of value until you buy something else with it or exchange it for goods or services or something that you need. So having cash in an online saver account typically means you're losing money, because a lot of them, even though they have 4.5%, 5% or whatever, there's usually, looking into the terms, you'll discover that that's only if you continue to add money to it. If you happen to skip a month of putting money into it, you'll actually go backwards and you end up not getting the bonus interest for that month. So instead of getting 5%, you end up with 0.5%, which is actually losing you 1.5%, 1.5 to 2%. So you need to be thinking about, on average, having as much money as possible, to the point where have a big money action plan. I've got an amount of money coming in from a transaction. I'm going to put it into a savings account for the period that it's going to sit there until I buy the next asset, because whilst it's sitting there, it could be earning me, say for example, you sell a house, have it in cash, then you buy a house. If you just have it in a normal bank account, you actually lose 1.5% on it on average in inflation. But if you have it in a savings account at 4.5%, 5%, whatever, you probably make $150 a day on $500,000, for example. So making sure that you keep it kind of on average better than you otherwise would have it. Otherwise, you're just perpetuating a loss. So have an asset, get another asset, try to do that quickly, try to reduce the amount of days that's sitting in a low interest account, try to minimize transaction costs, try to save on tax, try to delay expenses and accelerate income, and you will have money around you more often, and you will have a better interest rate, and you will have a growth instead of a decline. Keep that in mind and you might actually get somewhere. So the next thing you should do right now is go out and start learning about finances, whether you're watching these podcasts, whether you're listening to other YouTube videos, or you're reading books, or you're reading magazines, attending seminars. Start learning about financials. Question everything. Many people have got some kind of commission or financial incentive for telling you certain information. So be skeptical, but understand. Some things sound like a good deal. They're really not. Try to play both sides of the fence. Understand the mechanics and what's going on, and you'll have a much better way to navigate your way through your financial future. Thank you for watching. Watch out for the next video.